everyone. Welcome to KLI Market Commentary for August 2023. My name is Avijit Puri and I am part of the team managing fixed income investments at Kotak Life. Today I plan to share my views regarding the recent market developments and the backdrop in which the Monetary Policy Committee will be announcing its resolution later this month. Over the last year and a half, global central banks have embarked on an aggressive rate hike cycle with the objective of bringing back inflation, which had soared to decadal highs, back into their target bands. Headline inflation has since moderated, even though core inflation remains stubbornly high. At the same time, despite the most aggressive pace of monetary tightening in decades, global growth has so far stayed remarkably resilient, led by recovery in the services sector and normalization of supply chains. Positive data flow on both growth and inflation has spurred hopes for a soft landing, at least in the US. But with core inflation still high, central banks have continued to raise rates, albeit at a slower pace given the overall tightening that has happened so far. The Fed as well as the ECB announced a 25 basis rate hike last week, but refrained from providing any future guidance. Even the Bank of Japan introduced more flexibility to its policy framework in the context of rising wages and inflation. There is, however, a lot of disparity when it comes to the state of the economy and the resultant policy making. While a data-dependent stance for the Fed was motivated by softer inflation in combination with strong growth, ECB's stance was motivated by softer activity data. How higher rates go from here will therefore largely depend on how the near-term labor market and inflation data pan out. On the domestic front, the Indian economy is poised to remain the fastest growing major economy, with GDP growth expected to be around 6%. The next few quarters will, however, be crucial given the multitude of risks arising from the lagged impact of monetary tightening and slowing global growth. On the inflation front, the recent reading of 4.8% surprised on the upside, led by higher food prices. In fact, weather-led disruptions are likely to push headline inflation above the target band of 6% in July and probably in August too. The jump is almost entirely caused by vegetables, though these are likely to remain temporary and may revert over the next few months. Another element of risk arises from oil prices, which have recently surpassed $80 per barrel. There is some good news too. Underlying momentum for core inflation has softened over the last few months. The monsoon has also gathered pace with the narrowing in spatial disparities, which is visible in a pickup in kharif sowing. Food stocks also remain comfortably above the buffer norms and may therefore be used to avoid any undue spike in cereal prices. Given these factors, the RBI is likely to remain on hold and keep its monetary policy stance unchanged in the upcoming policy review. Going ahead, any change in policy stance will arise only if growth concerns surface or if RBI feels confident that inflation will sustainably revert towards 4%. With strong growth and sticky core inflation, market expectations of interest rates remaining higher for longer have firmed up, pushing bond yields higher. Over the last few weeks, the 10-year US Treasury yield has been hovering close to 4%. Tracking the global yields and given the near-term inflation risk, domestic yields have also edged higher, with the 10-year Indian government bond yield hovering around 7.15. We expect the Indian 10-year government bond yield to trade in the range of 705 to 725 in the near term. Despite the near-term inflation risk, markets do not expect any incremental rate hikes from the RBI. In addition, rumors around potential bond index inclusion will soon begin to build, with JP Morgan likely to announce its review result in September. Happy investing. Thank you.